Hey everyone, welcome back to the Weekend Charts. Charlie Bilello here, and as always, I'm going to run through some of the most interesting charts and themes that I'm seeing today. I want to start out this week talking about the U.S. jobs report. 199,000 jobs were added for the month of November, and the streak continues. So, what streak is that? Well, we've now had 35 consecutive months of payroll growth in the U.S. So coming out of that COVID recession, we're now at almost 3 years. It's hard to believe it's been that long. Almost 3 years where every single month we've seen positive jobs in the US. So where are the jobs coming from? If we look at November, healthcare, number one, 93,000. Government jobs, 49,000. That's been a big story this year. A big part of jobs growth. I think about a quarter of the jobs that were added are coming from the government. Leisure and hospitality, 40,000 jobs. That's been a big story, just kind of replenishing there. There was a big shortage. Now much less of a shortage in that area. And manufacturing, 28,000 jobs for the month of November. And a big part of that was the resolution of the UAW strike with the big three automakers. So, if we're looking at that healthcare sector, what's interesting is healthcare employment growth is increasing while other sectors are decreasing. And why is this happening? Well, there's really a massive shortage of healthcare workers in the US. If we look at nurses, doctors, pretty much anything related to healthcare, we need more of in the US. And that's really driving the growth, the demand is exceeding the supply by a wide margin. So this should continue. It's really a secular trend. Aging of the US population, we're going to need more healthcare workers definitely over the next decade. If we look at that unemployment rate, tick down, hit 3.9% last month. So it was rising a little bit there, but now moved down to 3.7%. And that's kind of still in the range of kind of Goldilocks for the Fed, where they're not yet worried about the employment situation in the U.S. So certainly, people saying the Fed needs to start cutting rates because we're seeing clear weakness in the labor market and worries about a recession. We're not there quite yet, and 3.7% unemployment rate still consistent with the Fed saying we're comfortable holding rates where we are today, and we'll talk about that in the Fed section, but looking at the U.S. employment to population ratio, this is another good data point in the report. 60.5%, that's the highest since February 2020. So you could see here the crash during COVID, 61% went all the way down to 51%. We've been climbing our way out of it ever since, and now we're at 60.5%. So hopefully this continues and we get back to pre-COVID levels. If we're looking at the single best statistic, I would say, in the employment report, it would be wages. And I think this is going to be a big factor in holiday spending this year. People are earning more money than last year. And not only that, it's a 4% increase in wages. Not only that, but inflation is actually lower this year. So unlike 2022 and 2023, wages are outpacing inflation. So we're looking at CPI year over year of around 3%. We have wages still growing at 4%. So while it's come down, this is the lowest wage growth since May 2021. It's still well above the average, let's say, of the last 20 years. So very good sign there for workers. They're still seeing wage growth. Now, what's going on with the labor market in terms of, is it tight? Is it loose? Well, we're coming from the tightest labor market really in US history. And every month we've seen a loosening, and that's really continued for the month of November. And one way to look at that, simply look at the number of job openings out there. And just a few years ago at the peak, we're at 12 million job openings. Now that's come all the way down to 8.7 million, still above where we were before the COVID crisis hit us. And it's actually now the fewest since March 2021. But you could see here, it's just a slow trend lower, and the fewer jobs that are opening, well, that means companies, the demand for labor isn't as much and they don't need as many jobs to fill. So still above average, still kind of predicting, I would say, more months of positive jobs growth in the next few months, but slowly normalizing here. Another way to look at this is to compare the number of job openings to the number of unemployed people. So if people are out of work, they're unemployed, they're looking for work, well, how many jobs are there for each of those unemployed people? At the peak, there was 2 jobs for every unemployed person. It's something we've never seen. That was the tightest labor market in history. And now we're down to 1.3. That's the lowest since August 2021. So still, again, a little bit above pre-COVID levels, but definitely a noticeable loosening in the labor market. One last data point on that front, we have the year-over-year growth in non-farm payrolls. So what are jobs on a year-over-year basis? What's the percentage increase? It's now down to 1.8%. So you can see here that's almost back to the growth rate before COVID hit. And so are we expecting huge number of jobs in terms of growth over the next year? No, it's normalizing here. The question is, are we going to flatline at this level, or is it going to continue to go down? And if there's a recession, obviously you would expect this number at some point to go negative. If it's a soft landing, well, it's just going to come down and at some point go sideways, kind of like it did during this expansion here. But definitely a good sign that the labor market is normalizing. People are coming back to work slowly, but each and every month more people are coming back into the labor force. So let's switch gears, talk about the housing market for 2024. And we've talked a lot about this year and the kind of huge surprise in the housing market in terms of really the collapse in terms of both supply and demand, which kind of lifted prices and elevated prices on existing homes. And we've talked a lot about affordability. So Redfin came out and gave some predictions for next year. I want to run through that. But first, let's talk about where we're coming from. And that's the pretty much least affordable housing market in history. And Redfin is looking at here in this chart here, what's the percentage of your income that you need to buy the median price home for sale? And in 2023, that percentage hit a record high, over 40% of your income. And so what are they projecting for next year? Well, things are going to be a little bit better for people looking to buy a home. And the reason for that is they're expecting essentially home prices to be flat over the next year. So assuming your income grows next year, if home prices are flat, well, that's one way affordability is going to be helped. Another thing they're saying is there's going to be more inventory and more transactions. So they're saying transaction volume is going to rise because we're going to see more inventory and affordability is going to be getting better. And what's going to be driving a lot of that is the fact that they're projecting that mortgage rates are going to come down. So their expectation is you're going to see the 30-year mortgage rate move down to 6.6% by the end of next year. That should help with affordability as well. And what we've seen over the past 6 weeks is a real sharp decline in the 30-year mortgage rate. This is obviously following the bond market, looking at treasury yields really plummeting over the last 6 weeks. Well, mortgage rates are following that move lower. We've moved down on the 30-year from 7.79% all the way down to 7.03%. So pretty rapid decline in a very short period of time. So what Redfin is essentially saying, flat home prices, more inventory, more activity, and better affordability because mortgage rates are going down, home prices are flat, and your incomes hopefully are still going up. So let's talk about the equity markets and the major market trends that we've seen this year. We've seen a huge dispersion in terms of equity market returns. It's very unusual to see various parts of the equity markets with such a wide spread in terms of performance. And we're seeing it not just in terms of style, but in terms of geography and other factors as well. So let's dig into that. We'll start with value and growth. If you remember from 2022, it was a huge outperformance of value stocks. We hadn't seen something like that in a long, long time. You had to go all the way back to 2000 to see value outperform growth the way it did in 2022. This year, complete opposite. So we've seen growth stocks up almost 36% here versus value stocks 6%. That's a 30% spread where growth is outperforming value. If that holds here through year end, that would be the second largest outperformance of growth over value on record. Only 2020 was higher than where it is today. So just huge comeback for growth stocks this year. And obviously that's been driven in large part by the technology names that you all know. So the big four in terms of Apple, Amazon, Google, Microsoft, also obviously NVIDIA, you can put that in there as well. If we look at the technology sector versus the S&P 500, this is a long-term chart here going back to 1989. You can see that resurgence of technology this year. We had that brief period of underperformance, which followed a over decade-long trend of outperformance, and then very sharply coming back this year. Now we have the relative strength, so the ratio of looking at the tech sector versus the S&P 500, the ratio of the two is at its highest since March 2000. And of course, everyone remembers March 2000 as being the last uh, dot-com bubble peak in March 2000. And so extreme relative strength here for tech for over a decade and a complete reversal from what we saw in 2022. Let's talk about the broad market versus the equal weight index. This has been a big story in markets this year. If we look at the S&P 500 overall, up 21%, so very sizable gain for the index this year, coming back from an 18% loss last year. But if we look at the equal weight, average stock in the S&P 500 not doing nearly as well, equal weight up only 7%. So that spread there pretty wide by historical standards here. Almost 14% spread where S&P 500 is outperforming the equal weight. Again, looking at data going back to 1971, if that holds, that would be the second widest margin on record, trailing only 1998. So pretty historic here to see the market cap index outperforming the equal weight by such a large amount. And again, similar to the last chart, a reversal from 2022 when equal weight was outperforming the S&P. So let's talk about large and small. This is similar to equal weight theme, but just looking at the Russell 2000 instead of the average S&P stock. Comparing the S&P to Russell 2000, big spread here, 13.7% year to date. Don't often see it that wide where S&P is outperforming by that such a margin. Past 30 years, we've only seen 2 years with a bigger spread. 2021 was one here, and before that, you got to go back all the way to 1998 to find a spread that big. So another big long trend here where large caps have outperformed small caps, and that's really accelerated this year as well. So U.S. versus international. What are we seeing this year? Well, once again, the opposite of what we saw last year. International outperformed the U.S. last year by 4%. But this year, U.S. coming right back, outperforming 7.7%. And this has been a long trend of U.S. outperformance. If you could see here, going back to 2010, very few years where internationals outperformed, and it's only been by a small percentage. Most of the time, U.S. has outperformed. And if you add up all of those gains, it's an enormous spread in terms of U.S. outperforming the MSCI EAFE index. So huge secular trends in terms of large caps, growth stocks, S&P 500 versus equal weight, and looking at U.S. versus international. All of these secular trends that we've seen over the last decade have really accelerated to the upside this year. And what the question for 2024 and beyond is, are we going to see finally a mean reversion where this starts to move in the opposite direction? 2022 looked like it could possibly be the start of that, but very quickly 2023 has reversed a lot of that mean reversion that occurred. And so we'll have to see what will happen here. But looking at that U.S. versus abroad, I think the most interesting thing that we've seen over the last decade plus is looking at U.S. tech versus China tech, looking at the NASDAQ 100 versus China tech. And it probably seems unlikely today, but people were very, very bullish on Chinese technology back in 2010. And what's happened in these two ETFs here since that point in time, we see the NASDAQ 100 ETF up 916%, the China tech ETF up only 63%. This is since the inception of the CQQQ ETF, the China tech ETF, back in late 2009. So just unbelievable, incredible spread here in terms of performance. And if looking here in terms of the spread here, this is looking at a ratio of the Chinese tech ETF to the NASDAQ 100. It's hitting new lows here in terms of relative strength. So the big question for emerging markets, of course, China being the biggest part of the index, it's about a quarter of the index in terms of emerging markets, is China going to have a comeback? And are we going to see a mean reversion? If we're looking at the emerging market index, I'll talk about this next week, versus the S&P, we haven't seen the relative strength this low in over 20 years. You have to go back to 1998, 1999. So very, very long period of underperformance for emerging markets, and China is really the biggest driver of that underperformance. So let's talk about stocks and bonds. And there's a perception that if stocks are going up, bonds should be going down, and vice versa. It's not actually the case. If you look at the long-term historical correlation between stocks and bonds, it's actually positive. It's not highly positive, it's positive. So there's no reason to believe that stocks and bonds can't go up together or down together, but it's not usually all the time. If you're looking at monthly data, what we've seen over the past 2 years is actually very rare to see the correlation this high. So we actually have a 0.74 correlation between the S&P 500 and the Bloomberg Ag Bond Index over the last 2 years. That's the highest we've seen on record, except for this brief period here in the 1990s, 1993 to 1995. And what we've seen over the last 2 years, why are bonds and stocks really moving together? Well, really, it's been the fact that this inflation fears and the market moving because of that inflation fears is driving a lot of that. So when equity market participants, when their biggest fear is higher inflation, like it was throughout 2022, then when bond yields are going up, reflecting higher inflation, stocks are oftentimes moving lower in response to that. So stocks and bonds are moving in the same direction because bonds move down when yields go up. So what we've actually seen over the past few months is almost a one-for-one relationship. We had that huge, not huge, but biggest correction of the year occur here in September and October, where the equity market was down a little over 10% in terms of the S&P. And what were yields doing? Yields were rising, and 10-year went up to almost 5% on a closing basis. It hit it intraday. We had investment grade bond yields rising, junk bond yields rising, and stocks were falling. And what we've seen since then is the complete reversal. Bond yields have come straight down and stocks have risen, where the S&P now on a total return basis is only about 1% below its previous all-time high, and the Dow has already hit an all-time high. So this is a very tight correlation. Will it continue to be this tight? Probably not. I think as inflation now is down to 3% in the US, if it could get back to 2%, if we get back to a more normal environment, I think you'll have a lower correlation. But as long as that's the big fear in terms of market participants, then you're going to see those two tied together. I think historically, uh, you have factors influencing the bond market, you have factors influencing the stock market, and the two necessarily shouldn't be tied at the hip. So just because interest rates are rising historically, that doesn't always mean it's bad for the equity markets. We've actually seen stocks do better during periods where yields are rising than falling historically. But when the fear is inflation, well, that's when you have a problem. And so as the attitudes start to shift here, hopefully inflation has been kicked and we'll see it continue to fall and go back to 2% or even below that. But to the extent that it hasn't been kicked and we're going to still see inflation fears, you're going to still see that correlation. So pretty unusual period over the last 2 years in terms of stocks and bond performance. And I think that really culminated in November, where we saw one of the best months in history for the bond market, with yields falling, and a very strong month for stocks. So perhaps that will be the top in terms of the correlation between these two important asset classes. So I want to talk about this interesting piece that was in The Economist, talking about how we're a product of our experiences as investors. And they were looking at a Vanguard study that showed a very interesting thing where looking at the equity allocation within retail investors' accounts. And you could see here for a period of time before in the 1980s, before 1990, it was below 70%. And then we had the huge equity boom in the mid to late 1990s. And you see that percentage really accelerate to the upside. Looks like it hit 85% or so by the late 1990s, when you had just that enormous boom in stock prices, where the S&P 500 was up 20% in 1995, 96, 97, 98, 99, each and every year, having these huge, massive returns. And probably no surprise that at that point in time that investors would have a high equity allocation. The surprising thing, though, is that they actually kept that high equity allocation. So this is looking back, saying if they opened the account in 1999, what is their what is the percentage equity allocation at the end of 2022? And it was still very high. And so, very interesting that we're really shaped by those experiences. So, we open that account and it's during a strong bull market. And even though the bull market is over and then there's a bear market, it seems like investors are still holding on to that period when they first opened that account. And we can see interesting thing here is in recently it also spiked up around 2021. Of course, we had that enormous return in 2020, 2021, and we saw that value go up. And now, if we look at the end of 2022, when stocks were down and big inflation fears, we saw that percentage go way down. So, just an interesting thing that we're all a product of our experiences. And when we enter the market and when we open our first account, really influences how we think about our allocations in the long run, which is just kind of surprising. Now, second surprising thing in that article was the fact that Gen Z investors, so these are younger investors, were actually had the highest cash allocation. So these are people born after 1996. You would think younger investors would have low cash allocations. They had actually a much higher cash allocation than the baby boomers born between 1946 and 1964. This was at the end of 2022. Now, they didn't show how this changed over time, so we don't know. This could be just simply Gen Z investors are more likely to trade. And after 2022 had a difficult year, they bailed out of their stocks and they saw that they could now earn a reasonable yield in terms of cash, in terms of money market funds. And so they decided to shift to there. But just interesting, unexpected finding from these Vanguard accounts to see younger investors actually with higher cash balances. Now, the other part is looking at the bond exposure. That's kind of more intuitive. Younger investors, lower percentage in bonds, much lower than older investors. So it's not all irrational, but the cash thing definitely surprised me. I would be interested to see where that cash allocation is today at the end of this year after a strong year for stocks. Did Gen Z take some of that cash and redeploy it? And I think that would tell you a lot about, is it just because they simply have higher activity, or are they actually more risk averse than, let's say, the baby boomer generation? So holding cash this year, needless to say, seemed like a good idea because cash was yielding around 4% coming into this year. Obviously, stocks have trounced cash. S&P 500 up around 21% this year. And was that predicted by anybody coming into the year? Very few people. If you look at Wall Street strategists, actually it was the first down year they were predicting pretty much on record. So definitely, as all these forecasts are coming in now, ignore them, follow your own plan, follow your own strategy. Don't listen to what Wall Street is predicting for any given year. It's just a crapshoot. There's really no expertise in saying where an index is going to be a year from now. No one can do that on a consistent basis. Definitely not advice that you want to follow. And this is just yet another example following 2022 when they said stocks were going to be higher and they actually went down. So nobody can get this right on a consistent basis. Do your own work as an investor, follow your own plan, and don't listen to these forecasts other than just for entertainment. It's interesting to read, interesting to listen to. I like to hear the reasons behind these forecasts that people make. It may give you some different ideas and ways to think about things, but don't be thinking about acting on it, because then you're acting on something that's not based on skill, but that's just based on a guess, just based on luck if they get it right. And you don't want to be doing that. So let's talk about the Fed. Next week, they're meeting. What are they going to do? The Fed is going to hold rates. The Fed always does what the market is expecting it to do. The market's saying 98% probability that they're going to hold rates at 5.25 to 5.5%. And every single meeting since 2009, the Fed's done exactly what the market was expecting it to do heading into the meeting. So yes, there's a 1.6% probability that they hike rates. I think that's not going to happen. Fed's going to hold rates once again, and nothing in the employment report would suggest otherwise, that the Fed feels like it needs to hike rates, let's say, again, because of a hot labor market, or inflation moving up. The recent inflation reports that we've gotten all showing a downtrend. So really no reason to hike. And given the strength in the labor market, the continued strength there, and the fact that inflation is not back down to their target, really no reason to cut yet either. What will they do in terms of the balance sheet? I think status quo there. They continue to shrink the balance sheet. It's now down almost 1.2 trillion from its peak. I think that continues for a while longer. They want to see this lower. If this continues for the next few weeks, it's going to be the biggest percentage decline and biggest dollar decline for the Federal Reserve's balance sheet on record for any calendar year. So pretty sizable decrease. Still a ways to go, obviously, to unwind this ridiculous level of quantitative easing that they did in 2020 and 2021 and early stages of 2022. But it's a good start. And I think they're going to send the message that it's going to continue at the meeting next week. And if we look at the Fed funds rate, and we compare it to the Fed's preferred measure of inflation, which is this core PCE inflation rate, you can see here the job isn't done yet. So Powell, at every single meeting, the market doesn't seem to believe it, but he keeps saying we're going to stay at it until the job's done. And to me, 3.5% is good. It's trending in the right direction, but the job isn't done until it gets closer to that 2% target. I've always said it's ridiculous. Why 2%? Why not 1%? Or why not 3%? Who knows? But that is their target. And the fact that they're still a ways away from there and we still have strength in the labor market would suggest to me that they're going to continue to keep this spread, keep it biased tight for at least a few more months. And we'll see. The big question for the December meeting is not going to be whether the Fed cuts or hikes, because we know they're going to hold rates. It's going to be for their projections in terms of what are their projections for the Fed funds rate for next year. Are they going to lower those projections to kind of indicate, yes, we're going to start perhaps cutting rates next year, or are they going to stay firm and wait on that? That's going to be what everyone's looking at in terms of the December meeting. They're going to be asking him about those projections and whether they're going to show an easing of policy next year, which is what the market's betting on, or whether the Fed's going to kind of stick to their guns and say, nope, not so fast. We're not there yet. We're still saying that we're going to hold rates where they are. So let's end, as we always do, with something positive, and that's the fact that if you've been waiting for the car market to start normalize, especially the used car market, which I've called a bubble. Well, it's finally happening, and it's starting to happening at a faster pace. So very good news for anyone looking for a car here in December, especially the EV vehicles and especially Tesla. So this is dramatic change in terms of the average price of a used Tesla. If you've been waiting for a used Tesla to come down to a price you can afford, it's now almost $30,000. It's $29,000, almost $30,000 lower than where it was in the peak in 2022. So it wasn't that long ago. You had the average price of a used Tesla at almost $68,000, and now we're at just a little under $39,000. That's a huge change in terms of the average price. And if we look at more broadly in terms of used car prices, what we're seeing here is continued good news. We have the latest update from Manheim in terms of wholesale used car prices, which is our leading indicator for retail prices. Well, now they're down to their lowest level since March 2021. They're 20% lower than their peak. So this is forecasting off of this. You would say retail prices should come down over the next few months. We're already seeing that. We have the average used car price now down to around $28,000. That's the lowest since July 2021, 29-month low. And this should continue. So finally, the used car market, I've been saying, when is it going to happen? It's been frustratingly slow here, but maybe finally here we're going to see prices continue to move lower, which is good news for consumers. And if you're still buying gas, you don't have an EV, and you're still buying gas for your vehicles, the good news is the national average gas price in the U.S. has moved down to $3.20. That's the lowest level we've seen this year. So all around good news in terms of transportation. If you're driving a car, it's cheaper. If you're paying gas, it's cheaper. And if you're looking to buy a new car, whether it's new or used, we're seeing improving price trends, especially for EVs. So we'll end it right there. Thanks everyone for joining me. Have a great weekend, and I'll see you next time on the Week in Charts.